TGIT Warriors. Hello, Mike Bergman, Michael Weisman, AJ team. How's everyone doing today? Again, the pound leading this correction to the downside.
Morning, Dale.
Hi, Ryan. So EG continues to perform, and just more of the same in cable coming in today. Any news on Aussie? Had a pretty good pop. It looks like it might be a failing rally, but what was behind the strength in Aussie?
Decent jobs numbers overnight.
Okay. Gold and silver pushing. Yen, just down a shade, still looks okay to me. If we get over 140, that was a nice short from 140 from Blake yesterday. It was good for about 80 handles, max range. What do you think here about the dollar? It still looks like it wants to go. And, I have this level up here at par 50 on the breakdown. That's about 80, 70 pips away. Do you think the euro cave? I was looking for 11.5. I guess it, never got there. I still think it can. What's your take? Are you dollar friendly for a little bit longer? Because this is what I was looking for. So now, if the pound recovers and makes new highs after this kind of pullback, it's going to have a difficult time confirming a new high if it does that.
Yeah.
And euro, even though it did nothing, it's going to have a hard time confirming. So that's what I would like to see in the next week or so is euro and cable making new highs without confirmation. So for maybe a better US dollar bottom. So I mean, just one thing I have to say, there's only one day left, but don't you think, like after last week on this big candle, this breakdown, that we should have seen some follow through?
Yeah, you're right. But then it's all about the repricing of expectations. Part of that big move was everyone thinking a peak for the Fed. Now everyone's trying to judge the peak for the others. So, the dollar's priced, if you know what I mean. Euro, Are we going to get a peak next week? Is the ECB going to hike and rule out September? And then we're at a peak there. Is the Bank of England going to do the same at their next meeting? Do a hike and then indicate a pause? So it's all, the dollar led the way with the Fed peaking, or supposedly they're going to peak first. Now we're waiting on the others. Now the RBA have peaked. You look at cable and euro dollar, they're off their highs. Aussie dollar's looking bid today against the dollar. So there's all different currencies going at different speeds.
A lot of cross currents. It's not trading. Yeah, not trading as much in a singular way.
Exactly. Your Dixie chart, when you had it on the shorter time frame, I didn't know you changed from dollar yen to Dixie. It was exactly the same. Exactly the same.
So that's what you're talking about, and then that's what you're talking about.
Yeah, exactly.
The yen looks a little bit more advanced, but they are, and they're trading together. So that's going to be interesting because, I'm looking for a dollar bottom, but I'm also looking for a yen short. So, we talked about this last week. Is it possible that the yen could be US dollar yen could be bad and the dollar rally in the next few weeks? So that's going to be, I think, throw a lot of people off. Actually, I did an interview and the comments were, bullish a dollar and bearish US dollar yen doesn't make sense, was one of the comments, along with being bearish the stock market and the metals are getting into my sell zone. I think that silver up here, I was looking for 25 to 25.35, and we're here. So
it's grinding, isn't it?
Yeah. and gold too is grinding. Looks like it has the makings of a reversal day here. I guess it took out some of those fib targets. Why don't I bring Steve in? Steve, how you feeling today? Okay. Steve is at a silent retreat, so I'm not going to bother him. I'll ask Blake what's on your mind today.
You know, good morning, guys.
Good morning, buddy.
Well, first of all, you know, hey, and good morning, Ryan. Oh, Steve is here. Okay.
Yeah,
there you go.
Sorry.
Your voice is
I'll
hoarse.
bow out. I'll be back.
Okay, so Steve, I know you're dollar bear. So
Yes.
are you looking for this rally maybe back to par and a half to get short the dollar? And what's your preferred short? What's your preferred short? Is it cable's been the winner on this correction?
USD NOK.
USD NOK. Okay. And why USD NOK? I know I have it up here.
Because it has already had an impulsive move lower. It started moving impulsively lower before anything else actually did from the more mainstream, and still remains extremely heavy. Hey, Grega, how have you been, mate?
Greg is here.
I'm fine, thanks.
So USD NOK that I'm searching for, I don't have it all with my currencies, but anyway, why don't I just show this for just a second? Okay, so, you know, Russia, we may pause one more time in the wheat, but I tell you, pay attention to these grains. Beans look heavy, but corn had a nice rally out of the hole, but I think wheat's really going to be the one. And it may look expensive until you look at where it was. This was the invasion. So, I mean, even if it's, you know, just a correction, I still think that there's plenty of upside. A correction back to $10, that's good money in wheat. Here's NOK, got it. So see, the wheat led me right there. So short side of NOK then.
Long side of NOK, short side
Long
of USD
side.
NOK.
Okay, okay. So
Grega, what do you think?
About dollar NOK?
Yeah.
Yeah, I absolutely agree. I think that there was a major breakdown from that high, clearly impulsive price action, and we have crude oil doing quite well. So I think that dollar NOK in general should resume much lower, I think. And we have stocks obviously in uptrend. So in risk on environment, finally NOK is making some hit back. And
since we have Grega here, Dale, I think we should
give him the screen.
I think we should give him some time, because it's not that we have, the rest of us are here on a daily basis, as you very well know.
I've surrendered the screen to you, Grega.
Yep.
You can take control of our TV sets like they did on Outer Limits.
Okay. So yeah, since you mentioned dollar NOK, let me open it real quick here.
You know, one thing I noticed, Ryan, out of all the world markets, the FTSE peaked like a month or so ago and isn't close to its highs. DAX is much closer to its highs, but FTSE is looks like it topped, and it's not going to make a new high. Could that be tied to the confidence of you know, the BOE and stuff, or just, you know, just a confidence crisis that, and I was always taught to look to the UK when it comes to, you know, rates and things like that, that they lead. They're kind of like, they foreshadow what's going to happen in the US. So anyone talking about the stock market over there being under pressure? You don't have the same.
No, because you've got to remember that the FTSE 100 is very much multinationals as opposed to pure UK stocks. If you look at something like the FTSE 250, it's been on a bit of a tear since late last month.
All right.
So that's probably a bit more of a better indication.
Okay.
It's still down a bit, but it's had a decent rally over the last few weeks.
Okay. I just wondered if there was, any kind of correlation to what's happening in the pound. And, there's a lot of euphoria here in the markets, and FTSE's been down for a while. Have you noticed that, Grega? Do you follow the foreign markets too? I know
Yeah.
you follow the DAX, but any comment about how the FTSE has really sold off compared to the other bourses worldwide?
Let me try to find where I have the wave counter, possibly.
Yeah, sorry to interrupt your flow, but I think it's important. I mean, most markets are threatening new highs or making new highs, and it seems to be diverging. I'm not sure why.
Yeah, and good morning, Grega, and
Hey.
thanks for showing us some of your wave charts here. One of the, I think what Dale you're suggesting, there are some markets that are really underperforming, like the DAX, but I would be really interested to see what's happening with the Nikkei, because the Nikkei looks like it's it broke out, but it really led the markets, like it led all the markets pretty much. Okay. And it looks like that strength has been waning recently. So yeah, that's another interesting one. Anyway.
Okay, thanks, Greg, for that. There is Elliott wave analysis on the fly. Look how fast he labeled that thing.
Yeah, I mean, normally we can label or recognize clear pattern relatively fast, and those are obviously the patterns that maybe we should pay the most attention on and focus on the markets that has a clear perspective. So here we have 5 waves up. And that's a very strong drop that goes to back
March. That's when we went to
when we went to
3,800. That was a banking deal.
Yeah. Okay. And so because, as you can see here, this low here from March hasn't been retested yet. That's why I'm thinking that we will stay consolidating here and that there can be much more downside. Obviously, if that was a completion of a 5-wave rise, then we know that, or we can assume that correction will not end that fast. So it can be something more complex and deeper. So I think that this index has plenty of room either to go just move to the right or maybe to the downside. And since mentioned, I think I have Nikkei somewhere here. Okay, so this on the top is Nikkei. Here at the bottom, we have dollar yen. And you can see that since start of the year, there was a tight correlation still going on right now. So I think that, as you know, moves out of a triangles are finally in a sequence. So I think that was some kind of will be maybe forming some kind of a 5th wave. Final thrust out of a triangle can cause a massive reversal. And this obviously could go hand in hand with dollar yen weakness, where we already see some very nice rejection down from that FIB levels. And I think that this dollar yen in general will continue to the downside. Obviously, it will also depend on dollar index that is breaking towards 100 level. I think that break below 100 level will cause much more downside for dollar yen. So I like dollar yen on the short side. It can be a bit challenging to enter the trades here because, as you can see, invalidation levels are far away. So I would be waiting for higher prices. 141 is ideal resistance. Also notice that there we have potential left shoulder hat and now in the right shoulder. So 141 definitely is the first level, maybe that the most attractive from my point of view. So I'm bearish on dollar yen. Will be expecting more weakness, but of course we just will need maybe another major catalyst for this move to the downside. Maybe this week.
That's exactly what I was saying yesterday when they asked me in the morning ads, Grega. I had to substitute you since you weren't there. I said that the first leg lower was impulsive, which doesn't mean that this is a change of trend necessarily, but it means that even if this is a correction, it is definitely not a completed correction.
Yeah, exactly. And I have this wave count here. So even if that's ABC going to be ABC drop, there will be limited upside, as you're saying, for a wave B.
Yes, exactly.
So yes, I agree. Definitely, I think can be a very nice opportunity on the short side while we are trading below 145. But even if we at some point break this level, I still think that there will be again speculations for potential new intervention. As soon if we closer move to 150, I think will be even greater chance that we will see a major reversal down. So no matter how I look at it, I think the dollar yen is, in my opinion, headed lower and will be trading much lower later this year. Also, if we look, since we have a guest today.
Yeah.
Okay. Anyway,
there's still time.
Okay. So last time I was here, as you know, we covered also gold.
Yeah.
We said that gold can be headed higher, and so far it broke very nicely to the upside of also after head and shoulders bottom formation. We just moved into this very strong resistance, but I think this could be a temporary resistance because that was a pretty nice impulsive reaction, very strong and extended lag up from 1900. So I think that more upside here could be seen. Also, we are seeing gold moving higher despite the dollar index just making a consolidation. So I think when dollar index could potentially resume the downward move, I think that gold could actually see much more upside. But of course, if someone is looking to join this trend, maybe you better wait on dips towards 1950, 1960. That would be support at this previous minor consolidation. Or maybe even silver can be much better choice here because gold-silver ratio is, as you know, is moving to the downside. And here we have a much clearer...
As it usually happens when we are in a bull trend in metals.
Exactly. So we have here a very nice, strong, extended lag. We are passing and trading now above that resistance, which could be a new support here on the next dip. So definitely 2450 could be the first attractive level, maybe to join this uptrend. Also, what I have here, maybe the S&P 500, as we spoke last time, more upside here could be in the cards, but of course we should be aware of corrections, looking at maybe on a smaller time frame. Okay, so we are seeing prices in a fifth wave of a higher degree, wave 3, and each motive wave should be made by 5 waves. So if you look at the substructure here from 4370, that's not the case yet. So maybe in the short term there is room for more upside, but for a next major move to the upside, I would rather wait on a higher degree correction. But I think that stocks are very nicely trading to the upside. We have finally DAX also making a very nice recovery, which, by the way, has seen a pretty strong drop here at the start of the month.
Right.
But if you look closely here, just let me load my charts here. It's actually a very nice clear free wave drop from all-time highs, right? So this was a correction, while the current bounce clearly looks impulsive. So I think that more upside here could be coming, but watch out maybe for 16,000 to be retested. 1500 or 15,900 is the next support. So this 15,900 will be also this broken trend line of this channel. Okay, so I think that so far we have a pretty nice clear directional moves. Stocks are in risk on mode, but just there can be some pullbacks. Dollar is on a back foot. We are finally seeing now, maybe, I'm not sure if this will hold, but commodity currencies have seen some pretty nice lag higher in the recent session. So I think that, by the way, I have here, before I go to Aussie, maybe, I'm looking here at Hang Seng Index, right? It's a very nice big potential head and shoulders formation. Of course, this takes a long time for it to unfold, but I think from a longer term perspective, it's pretty interesting. We know that China is doing everything to support their economy, but we will have to be patient because with the high rates elsewhere, obviously, since you know that we are connected to China pretty much, so it won't be easy for China to pick up that easily. But I still think that looking maybe from 1 year from now, we could be headed trading much higher.
Greg, you have any cycles due on the VIX? I know you had a VIX chart where you had all kinds of different cycles when things were due to pop.
No, I don't have it here, but
Okay.
where it is. I don't have it here, but I have, as I know, VIX is still at the lower side of a very big range. So it looks like that market it's a bit too confident regarding the current uptrend.
Yeah.
Yeah.
It tried to push up a little bit yesterday.
Let me just, not sure
It's
why
okay if you
trading
don't
view
have
is
it, then
loading.
that's fine.
So
It's loading kind of slow today. It's
Yeah.
weird. I've never seen your charts do that, Grega. It happens, I guess.
okay, so here's VIX at the lower side of this range. So definitely, I mean, buying here, when looking at VIX, buying here stocks, not the best thing to do, right? So maybe
Yeah.
we just need some kind of a volatility here to send the price down, and then I would be looking to buy the dips, especially if at some point VIX will spike higher. And as I said, next higher degree wave 4 could be maybe the case.
Where's the invalidation of that S&P count?
4,200.
Support, there's that number. Okay.
That was a massive resistance
Right.
here from
Right.
the start of the year, basically.
Yeah.
It could be, Blake would say, bull bear level or something.
Yeah,
Okay.
definitely.
Yeah. Okay.
Yeah. Okay.
Anything
right.
else, buddy? Was it?
Anything else? Maybe cryptocurrencies, because Steve loves them so much. I can cover this for him. Maybe just look at these cycles. Okay, I know that this can be obviously coincidence, but notice that Bitcoin, each time that when there was a pullback, there was a 30 month of a pullback here, 12 months of a pullback in 2019, 12 months in the pullback from 2022 highs. And then after these corrections were completed, we have seen 35 months of recovery here and also here. So it means Bitcoin was in a pullback for 1 year. And after that, each time there was a 30-year bull run. And if we respect these cycles, maybe we are in a new bull run, meaning that cryptos for the next 2.5 years left, there can still be opportunity on the upside, especially now when we have maybe Fed also approaching end of the hawkish cycle. So
well, that's actually really good news for Steve's barista, who can then retire. Right,
Yeah, if he hadn't already lost everything, right?
All right. Hey, thanks, Greg. We got about 7 minutes till data. I appreciate you coming in and giving us your views. Really quick, I want to just give everybody a quick view of like just a few currencies this morning as we head into the data. We're actually seeing the Aussie, the Kiwi hit lows of the session. Aussies have reversed all of its, most of its gains that it had in European trade. You can see the Kiwis, getting down towards lows. The sterling's getting down towards really key support. This is the breakout point. 128.50 is a level we've been looking at all week. And, you can even see the euros, looking a little vulnerable as well. So the dollar's perking up here. And I think we need to pay attention to that. Dale, you talked about the dollar yen, 140 level. I think we have the flag resistance comes all the way up to the 140.25, especially if we have a good data release today. If we have, you go just, look at the weekly unemployment claims. Like, let's say they continue to show improvement. There's a little bit of an improvement last week to 237,000. Let's say we match that number, maybe even a little bit lower. You'll see that dollar yen spike up back up above 140. So 140.25 is going to be pretty big. We do have Philly Fed as well. Ryan, we have just a couple minutes till data. Do you have any thoughts before the data comes out? Anything particular you're looking at?
No, I'm going to keep an eye on the jobless claims numbers. we have a big option expiry in dollar yen at 140, so I wouldn't be surprised if we're hanging around there a little later in the day. But yeah, just keeping on the data. Any big outsized numbers is going to move the market.
Yeah, and just so everybody can see that here's the options data that's that Ryan's talking about. So big you know, 3.74 billion right
Wow.
there. Wow, that's a big one.
biggie.
Yeah, that's a big one. All right. So
That's
anyway,
not retail. That can't be retail.
No,
that's Steve.
that's
It's all Steve's orders out there. Dale, what do you
100%.
what are you thinking, Dale, as we go into today?
I think the action in this guy Blake Morrow showed exhaustion in Apple on Twitter yesterday. I don't know if you ever heard the guy.
Yeah, there's that dude.
And Nvidia is not making new highs with the market. It's really been the poster boy. So, you know, maybe it's only going to be a correction like Greg is talking about, but I wouldn't be long here.
Well, you know, if you just, you know, look at the S&P, we're at channel resistance somewhere around here. We're up there.
NASDAQ's weaker. It's the preferred short. They're taking more out of tech. I think there's a rotation going on out of tech into things like Caterpillar and Deere, and even the financials are acting better. The oils, which have been underperforming lately, are starting to come to life. So it's almost like the market is starting to rotate out of tech and go more to real economy or value stocks out of tech.
Yeah. All right, Steve, you have any thoughts before we have weekly unemployment claims today? And Philly Fed?
No, this is another piece of data that will definitely play some role. But in general, as I was saying yesterday again and before, and I see that Greg is on the same page with me, I think that we already have the trends in place and we already have a specific theme, and I don't foresee any big changes other than temporary, you know, potential counter trend moves. Nothing moves in a straight line, right?
All right. So one of the other things, and I failed to mention this a little bit earlier, and we'll be watching yields following today's data and probably watching today's price action as well. Take a look at your 10-year. You know, everybody's, you know, keeping an eye on yields. Look at the 10-year bond market. Notice that the 200-day moving average in the 50 DMA and also the 618 retracement all come in around 113 on the 10-year. That's capped us. This is you can see this is a daily chart. That's really capped us for this whole week. We start breaking above there, yields are going to start coming down. That can have a negative effect on the dollar. Obviously, it's going to move gold, precious metals. You know, if you start to see yields really pull back and the bond market rally. So just keep that one on the radar. I think it's important. I don't know if we're going to breach it today, but you know, because we've just been struggling there all week for the last week, but it's something worth noting. Okay, we're about 2 minutes away from data. You know, also, Steve, one of the other things you had mentioned, the US dollar Norwegian Corona, really easy or very basic view of the US dollar Norwegian Krona.
What a cool website.
Hey, check out you know, we have a head and shoulder pattern that's trying to play out. There's also a bear flag pattern, which, by the way, is probing these lows today. So just, you know, it's kind of something that very easy way to look at the US dollar Norwegian Krona. But let's pull up the data flash really quick, and let's go over to the live charts, and let's go over to I'm going to put up these 3 charts. Let's go over to the dollar index. Dollar index will be over here to the far left. So you'll see 10-year yields right in the middle, dollar index, and we have the S&P right in the middle, excuse me. Yields are to the right, and you're going to see the dollar right here. And I did not mean to do that. Hold on. Let me grab that data flash again. Here we go. Let's see what we've got for jobless claims and Philly Fed. Data should be out in just about 10 seconds. All right. And, you know, the S&P is right in the middle, FYI. So, like I said, these commodity currencies are getting smacked, you know, as we come into the New York Open, which is interesting. All right. Do you guys see any of the data coming out? Brian, do you see anything? Oh, there we go.
Jobs claims 228K, so better than expected.
Look at that. I mean, we're gonna probably get that dollar yen, Dale, up to
Yeah, they're 41.
yeah, well, yeah, 140. I think he'll make it back up to 140 again. But yeah, look at the dollar just kind of was leaning into that.
Philly Fed a bit worse than expected, minus 13.5 versus minus 10 expected. Employment is worse than expected, -1. Prices paid a little bit of a pullback, 9.5 versus 10.5 prior.
All right. Well, you know, that Philly Fed might prohibit the dollar from making too much of a recovery. But let's not forget, guys, the dollar index is in breakdown territory. And unless we get back above 101, I mean, you just have to imagine the dollar, you know, there are going to be buyers on pullbacks. You get the euro down towards 111.50, 111. Yeah. You're going to see the, you know, people stepping in to buy the euro, people, you know, stepping in to sell the dollar as we've seen this recovery. There's a big bull bear debate about the dollar and whether we're really oversold or this is something that's starting the, you know, starting new right here. So it's going to be very interesting to watch over the course of the next couple of days. Remember, we are heading into the end of the week. But more importantly, I want to say thanks for everybody hanging out with us live today. And we have a great guest coming in today with Eric. Is Eric our guest today, Dale?
Yes, he is.
The one and only. Well, the one and only. I love having Eric here. You guys are in for a real treat today. Probably one of my, and I know I've said this before, and I do mean it. He's one of the younger macro minds that I really enjoy, and I think you guys are going to be listening to him for years and years to come. So let's bring in Eric, and hopefully he's here.
Eric, your young, fresh mind. Is it a little more fried? Is it a little more fried, Eric? After looking for a hard landing, and people are saying, "Hey, Eric, where is this hard landing?" And you said to be risk averse, and the market's rallying to new highs. What do you say to people when they say that to you?
I thought you were going to be easy on me today, Dale.
No, I know. I'm always easy on you, and I'm just saying that I believe you're right. And you know what?
I'm just teasing you.
Well, we all take heat based upon what our convictions are. And at times we may not be wrong, but we may be a cycle early. How are you explaining that your numbers, that you're sticking to your guns? And what do you say to people that say, well, you've been talking about a recession, Eric, for, 6-9 months, real estate crash. Go ahead.
The best way to answer that question is just by looking at the data, because we can't. Oops, hold on. Let me see if I could. Are you guys seeing my slide here?
Yeah, got it. Aggregate coincident index.
Okay, I can't expand it, but we'll just. Okay. I'll just assume that's good enough. It's visible. Okay, so the best way to answer the question is just to look at the data, because the data is what it is. We can't really argue it. We can't debate it. It's just a factual representation of what's been happening in the economy. So as a reminder to everyone who may be new to my process or not familiar what I do, I track business cycles. Business cycles are defined by the expansions and contractions in aggregate economic activity. Aggregate economic activity is defined by the combination of income, consumption, production, and employment. I didn't make up this definition. I didn't even make up this basket of indicators. This basket of indicators is published directly on the NBER website as the collective group of indicators that they use to define the peaks and troughs in the business cycle. So this aggregate coincident index, this basket of income, industrial production, two measures of employment, retail sales, total consumption, we all should be able to agree that this objectively represents the economy in the best possible way, covering all different sectors, employment, consumption, etc. So the reason that I began to say that the economy was in the imminent recession stage last year is because that's what the data showed. So when we look at business cycles, we can define roughly 6 different stages of the business cycle. One of the stages is the pre-recession or imminent recessionary stage. That pre-recessionary stage would be defined by the aggregate coincident index or aggregate economic activity slowing to below trend levels of growth. Trend growth being represented by roughly 2% growth. Now, this data has been revised slightly, but you can see in the chart that the economy slipped into below trend growth in October of last year. So we're growing at 1.9%. Simultaneously, in October, leading economic indicators, which I don't have charted here, but we all should be roughly familiar with things like the Conference Board Leading Index or all of the other traditional leading indicators. In October of last year, all of the leading indicators were deeply, deeply negative. Negative to the extent that is not normally seen outside of recessionary periods. So when
and that was a low in the stock market last October.
That's right.
So have you ever seen this kind of disconnect between what happens, you know, the stock market's supposed to run on economic fundamentals too, right? Earnings, all of that stuff. I know there's financial engineering.
Sure.
But have you ever seen a disconnect like this?
Yeah. So it's not, I mean, I certainly would have expected things to fall apart faster than they have, but this is not really outside the bounds of normal. I'll just wrap up and show you a couple of charts. So basically the proclamation that the economy is in the imminent recessionary stage is not really opinion driven. It was data driven by the fact that the aggregate economy was below trend and decelerating, and leading indicators were contracting. So if leading indicators are contracting and the aggregate economy is slowing and below trend, that's imminent recession, because your next stage would be coincident indicators like I'm showing here, negative, while the leading indicators are negative, and that's a recession. So when the economy goes into this sub-trend growth rate with negative leading indicators, that's an imminent recessionary stage. And we've been in this stage since Q4 of last year. The growth rate has continued to slow. So all of these narratives about the economy is accelerating, things are improving, it's objectively false, shaped exclusively by market momentum, which I can totally sympathize with, but we have to be careful about following the market and then backfilling an economic narrative. The factual representation is that the economy continues to decelerate since Q4 of last year, remaining in this imminent recessionary phase because leading indicators haven't improved and aggregate economic activity is objectively slowing, although it's taken a number of quarters to slow from 1.5% to 0. So we've only had, basically 30 basis points of decline from Q4 of last year till today. A lot of this is driven by employment, because if I strip out the two employment components and I just hold income, consumption, and production, then we do see negative growth rates. So the call is very much the same, irrespective of the gyrations in the market. And then just before you attack me one more time, Dale, can you see this new slide deck that I'm putting up here? Week 28.
I'm patient. I can wait.
Do you see week 28 here? Or did it not? Let me stop and reshare. Hold on.
You have a good company. Lakshman's work.
I do.
The business cycle. I mean, he's in the same camp as you, and you know, he's seen a few.
Yeah, no, I get it, and I just want to provide some facts for everyone to contextualize what's happening here. So, can you see this long and variable lags?
Got it.
So what this chart is showing is the lead time between when the conference board leading index has its peak and the recession starts. And the problem is that we go into this imminent recessionary phase, and it's unmodelable, unpredictable of whether it's going to be a 9-month period or a 22-month period or a 14-month period. You tend to throw your weight in, at least initially, at the average or the median, because that's the most logical place to take a first swing. But it doesn't always mean that it's going to fall on the average. And we're still within the bounds of historical norms, assuming the recession hasn't already begun, which it's entirely possible that it has based on some of the indicators that they use to define recessions. But I want to articulate one point here, Dale, which is that in 2008, it was the deepest recession we've had since the Great Depression. The conference board leading index peaked 22 months before that recession started, which was a record. But what's even more difficult about that period is the recession started, the 22-month period was defined by December 2007. But the market in May of 2008 was within 7 or 8% of its all-time high, similar to today. So if you're looking at when the conference board leading index peaked to when the market fell apart, the 2008 recession period was probably closer to 30 months. If you look at the time between the first month that the 10-year 3-month curve inverted to when the recession started, we can see that the lags are long and variable. It's 6 to 17 months. We're currently at 9 or 10. But again, the 2008 period was very long, 17 months to the recession start, probably 24, 25 months until the credit events really started to proliferate. Right. And what this chart shows is the monthly performance of the S&P 500 from the day the yield curve inverted, for every single recession. So what this chart is showing is that in 1970, the yield curve inverted. The maximum upside that the S&P 500 had from that inversion point was 0.7%, and then it ultimately had a 30% drawdown. In 1980, the curve inverted, the market went up 20%. In 2008, the curve inverted and the market went up 20%. This is a little bit dated. We're up about 16% now with the NASDAQ up 40. So it's not dissimilar to what's happened in the past. But I want to, again, refocus on this 2008 period to sort of articulate why it's imperative that you remain focused on a data-driven process. Because, Dale, if we go to our leads and lags, you had a yield curve inversion or you had a contraction in leading economic indicators. It took, as we just described, let's say 25 months, and the market went up 20%. So we would have been in a situation saying, hey, this thing's never coming, Eric. You said that the yield curve inverted. This time is probably different because the yield curve inverted. We're 23 months later. The market's up 20%. The cyclical and high beta stuff is probably up 30 or 40%. What recession? Turned out to be the biggest recession we've ever had. All of those conditions were already in place while the market was rallying. So the market momentum is not something that would throw me off my view, since I'm economic cycle first, market second. I'm always going to take my signal from the economic indicators and the economic data. The market will do what it does. It can go up into recessionary periods. It can rally 10, 20, 30% after the curve inverts. And we just have to be really careful that there could be periods where the recession is already baked into the cake in terms of contracting leading indicators, inverted yield curve. It could take 18 months, 20 months, 22 months. The market can rip in your face while that's happening. but you have to, if that's the game you're going to play, have to be nimble enough to recognize that once the curve inverts and these leading indicators contract, your risk reward is highly skewed. Although it's not guaranteed like the 1990 period. But this is the setup that we have.
How are you advising business to prepare for this? You're talking about that, they should be trimming budgets.
It's funny
from full-time to part-time.
It's a great question. And about half of my clients are asset manager clients, and half of my clients are corporate clients. Manufacturing companies, commercial contracting companies, trucking companies. And if I have 2 calls in a day, Dale, let's say I have 1 call with an asset manager and 1 call with a trucking company. The trucking company is talking about how it's the worst environment they've seen since 2008. They're laying people off for the first time in 20 years, and they're gearing up to potentially liquidate some of their capital goods and trucks because it's a really brutal environment. They have absolutely no disagreement about the recession is fully underway in their sector, and it is, quote from them, the worst environment they've seen since 2008. And I hang up the call and I go to my asset manager clients and they say, hey, what recession? The S&P is up.
Right.
And it's a good reminder that the S&P is not the economy. So what's interesting, Dale, is that the time for my corporate clients to act was in Q4 of last year when we went into the imminent recessionary phase. That's when they should have been trimming their headcount. That's when they should have been thinking about reducing their inventory and capital goods stock. Now it's too late.
I see. So they're hunkering down where
they should have been hunkering down. So, I'm obviously teasing, but when you came on and said, where's the hard landing? That sentiment, and I totally am sympathetic to it, is entirely driven by the whims of the 7 NASDAQ stocks. It's not driven by what's actually going on in the economy, the actual economic data, because the companies that I speak with are absolutely experiencing onset of recessionary conditions already, depending on obviously where they fall in the economy. The trucking and the cyclical guys are obviously on the leading edge of that. So the view on the economy is still, frustratingly or not, that we're still in the imminent recessionary phase. Leading indicators are still declining. And aggregate economic activity, as objectively measured by the index that I showed, is still decelerating, even though it's decelerating at the moment at a snail's pace.
Is the Fed going to compound the problem again this month by raising rates?
Of course. They're going to raise rates, and that's going to make conditions.
They're anti-growth, aren't they? Because now they have non-inflationary growth happening, right? Inflation's coming down, and I'm calling growth, I guess, the S&Ps. But earnings have been okay for a lot of these companies. It's carried the market. So when your asset manager calls and says the S&P, there is no recession, S&Ps, how are you advising them?
Well, I present the data the way that I did, just with you, showing them the performance. And look, it's entirely possible that this yield curve inversion does lead to a recession, like every other yield curve inversion. But we have, like I was showing in the chart, a 1990 scenario where your upside in the market does end up being larger than your downside. And you say, well, you're an idiot for not being in the market. But it's not playing the historical odds. And this is not, 2 cycles. This is through inflationary periods, non-inflationary periods. And the extent that the market rallies has nothing to do with how big the decline is. And I would just reframe this chart, which is that the decline is the decline from the day the curve inverts. So if the curve inverts, like in 2008, the market goes up 18, this is the maximum drawdown from the inversion point. So the peak to trough drawdown in 2008 was more than 43% because we rallied first and then declined.
Right.
So that's how I would be couching the conversation. And of course, we can get into more nitty gritty depending on what assets they manage and things of that nature. But the risk of recession has not been ameliorated at all, despite the market rallying. In fact, it's probably been exacerbated because the Fed, like everyone else, views the S&P 500 as the economy or as quote unquote financial conditions, which has caused them to raise rates more.
Yeah, this gives them a strong market, gives them more latitude to make mistakes and keep tightening.
I also want to show one more chart at the risk of being,
what?
Making excuses. This chart's a little bit dated. Can you see this one? Stock performance since 10-year 3-month inverted.
Yeah, got it.
This chart's a little dated, but that demarcation line of March 9th, 2023 is an uncomfortable reality. That's just what happened. This NASDAQ is closer to 40% now since the curve inverted, but we would be having an entirely different conversation, Dale, if the NASDAQ was not up 40% in a straight line. And it's hard for me to imagine that the economy's conditions improved and recessionary conditions were avoided because 2 of the top 20 banks failed. We bailed out a couple of tech-related venture funds, and then the NASDAQ went up 40% in a straight line. I wish the demarcation line wasn't March 9th, 2023, but that's just the reality of what happened. So I think we have to separate the speculative forces in the market that can be swung wildly by interventions and bailouts and things like that, all of which is part of the game. We all play the same game, so you have to just take it for what it is. I'm not trying to complain and say that, this is not fair. I think a lot of the things they did in that moment were out of bounds for sure. It is the game that we play, but it's an uncomfortable reality that things were not as they are now up until the day that happened. And then the day that happened, we saw a really significant change in the stock market. So I just want to sort of present all the information so people can...
it's almost like SVB saved the market because the Fed injected liquidity because of that. And it found its way into the market.
It could have, it was something related to that. It was something related to that. I mean, it could have been that a couple of large tech-related venture capital funds should have lost somewhere between $1 and $7 billion of uninsured deposits that would have probably bankrupted their entire fund, but they got 100 cents on the dollar.
It's unbelievable.
Look, and look, these are, again, I'm not saying any of this to complain. These are all, we all play the same game and we all have to take these things in stride. But what I'm really trying to articulate here is that we have to be careful about saying, oh, we're not having a recession. The recession has been avoided. Things have been improved because the NASDAQ has gone up 40% in a straight line after a bunch of tech firms got bailed out. The conditions that create a recession, the momentum in the economy, the sequence of the business cycle was unaltered by those events, but there was a liquidity injection. There was certainly a signaling effect from the Fed that despite our tough talk, we may still be there to prevent serious credit events to the extent that we can. And the market is basically saying, in the absence of really harsh job losses, which certainly haven't appeared yet, in the absence of job losses, if I'm looking at the actions, not the words, it looks like we have no job losses and somewhat of a supportive Fed.
Okay.
The job losses, in my view, are still very much on the way, even though they're, like I was showing in those lead lag charts, they could be delayed longer than average, but it's not, entirely outside the historical range of outcomes.
I read somewhere that the reason the employment numbers aren't changing is that instead of millions of people not being counted as unemployed, they've enrolled on the disability rolls, and a huge increase of people that may have been workers. They're not collecting unemployment checks, they're receiving disability. Would that fuzz up the numbers when it comes to employment?
I think there are a lot of issues with the BLS data in real time. I think it has more to do with coming off of an inflationary period where revenues are high, but production volume is declining. So let's use the example of a car manufacturer, just to make it easy for everybody to understand. Let's say you're a car manufacturer and you have 10 people and you produce 10 cars and you sell each car for $1. So you have $10 of revenue, you produce 10 cars and you have 10 people. What's happening in the economy is we've gone to 5 cars worth of production, but we're selling the cars for $2 instead of $1. So your revenue is the same and you're maintaining 10 employees, even though you're only producing 5 cars now. And the reason that you're retaining the employees is because they were very hard to get. And there's a feeling that maybe in the future, we'll go back to producing 10 cars and we need them. But at the moment, what that's imputing is a collapse in worker productivity, because now you have 10 people producing half as many cars.
Right.
Declines in worker productivity is a leading indicator of employment, because that situation can only last for so long. Volume has to improve, or it ends up eroding your profit margin because you can't pay 10 people to produce 5 cars. So in a well-constructed leading indicator of employment, you would have all of these things that employers would do first. So what I would, and I wish I had a couple more charts to sort of explain this one a little bit more. But what this chart shows is the Conference Board Leading Employment Index. So the Conference Board, they have a leading economic index, but they also have a leading employment index. And what's in the leading employment index is all of the things that you would traditionally expect: jobless claims, hours worked, industrial production, all of the traditional leading indicators of employment. And what I'm doing in this chart is I'm graphing the relative performance, or the ratio, between the leading employment index and non-farm payrolls. So when the line is moving down, that means the leading employment index is underperforming non-farm payrolls, or it's implying that non-farm payrolls will decline. As you can see, every time the ratio in the chart declines a lot, it coincides with business cycle peaks and recessionary periods. The magnitude of the decline that you're seeing here on the right-hand side, if we measure this from peak to trough, the percentage decline, it's been a 7% decline, which is not historically seen unless the economy is already in recession, already losing jobs, except for the 1974 period where we kind of had these levels into the beginning of the recession. The point being is that all of the things that turn the gears of the labor market are turning. What we have is somewhat of a labor hoarding scenario, because revenues are lagging because of inflation. We have a little bit of fear that these employees were hard to get, so I don't want to lose them. But as the cycle continues to cycle, the leading employment variables are going to continue to decline. And to the extent they hold payrolls flat, this is going to keep moving lower and lower and lower, to the point where they have no choice, but they have to start to get rid of headcount. So when you talked about, have you changed your view? All of the data would have to change.
Never really asked you if you changed your view.
So, if I
asked
saw
you
these things,
what you hear from your subscribers and people on social media saying, Eric,
I get you.
The market's gone up, and it was a time to not take risk, and risk paid off big.
No doubt. Risk also paid off big in '99 and early 2000. So there's all these times, and I totally get that.
Anyway, what's your
my
self-talk
framework
when you
is that
hear
I will change my view when all of these indicators start to inflect upwards. So if I saw leading indicators turn higher, and then I saw aggregate economic activity move from 1% to 1.5% to 2%, clearly we'd be in a new regime. But if my process is based on the sequence of indicators, leading indicators, coincident indicators, and lagging indicators, and the leading continue to decline, the coincident continue to decline, I can't change my view just because the market has gone up. If I did that, I wouldn't really be providing a service to anybody. You can just follow the S&P 500 instead of listening to what I have to say.
Yeah, I respect you for having the conviction not to change your mind based upon the evidence that you see. I just, it's just from someone else who's in the industry. I was curious how you handle that, because I know you're hearing that.
For sure.
You know why I know? Because I'm hearing that. Okay?
Yeah,
I've been bearish, since May. Okay,
yeah.
So go ahead.
I would also say that it depends, and the level of frustration that I sense with clients sort of depends on who they are, what they do. So obviously, my non-asset manager clients have no frustration with the economic prognostications. They have frustrations with their business because they're experiencing downturns. Look, if you were outright short the market, obviously that would be a painful experience. If you were just in short-term treasury bills and short-term notes, you're up 4 or 5%. So you're not down. Your pain is just that your neighbor is in the NASDAQ, right? And it all depends on how you approach your asset management, what kind of strategy you have. And I think it's really important for everyone to kind of know what their strategy is, so that during periods like this, they're not swayed to do things that they do. Give an example.
Mike Delfino just said it all. The market is not the economy.
Yeah. And what's funny is that everyone always talks about Warren Buffett. He's outperformed the market over a long period of time, greatest investor of all time. But at these cycle peaks, there's always the article that every single time, has Buffett lost his touch? Because when the market's going up, if you think about it, he's basically a 10-year, 3-month investor. When the 10-year, 3-month inverts, he goes to cash. He waits as long as he possibly needs to. Then the curve blows out and he rips somebody's eyes out. But if I told you, if you look at a 10-year sample of Buffett's performance and he outperformed over the 10-year period, how many of those 10 years do you think he underperformed?
Oh yeah, he rode down. There are a lot of bulls right now that are taking victory laps that stayed bullish all the way through 2021.
Yeah,
during that decline.
And even before that, right? He was piling cash in 2006. He didn't get to rip anybody's eyes out until 2009, right? So he was waiting there for 3 years. And I try and, not saying that everyone's Buffett, and I'm just contextualizing that if you're playing the business cycle, which is what I do, you have to be prepared mentally for periods that could last, like I showed in the chart of leads and lags. You have to be prepared for 12, 18, 24-month periods of time where the market can be going up and down and gyrating around what's happening in the underlying economy. He obviously has been extraordinarily successful over his career, mainly because his patience is better than anybody else on earth. He'll underperform for 4 years in a row, let alone 4 months. So I think
it helps having deep pockets, doesn't it?
Well, it does, but a lot of it is just that he has had how long has he had $100 billion of cash for? And why hasn't he deployed that? Right. Mm-hmm. So my point in saying all this is that what I do and the business cycle process is not for everyone. It's not for anyone that wants quarter-to-quarter performance. It's not for everyone that wants every 20% move in Bitcoin or high-flying tech stocks. It's really a long-term process. the business cycle peaked in late 06, early 07. Things didn't really bottom until 09. There are obviously repeating examples of these things take 2, 3, even 4 years to play out sometimes. And there are a lot of wiggles in that time period. So if you're going to be a business cycle investor, you have to approach it with that kind of mindset. And you can have a business cycle background and then have some more technical or trading oriented overlays like what you guys do to try and maybe catch some of these fits and starts if that's something that you enjoy doing. But if you're going to use a business cycle process, you really can't expect to get every 2 quarters of moves. And like I was saying, we wouldn't have been having any of these conversations until after March 9th. So we're really talking about, a 5-month period here, and a business cycle process is not designed to catch 5-month gyrations in the market. So it does tend to be well suited for big corporations that turn a big ship that has to move a little bit slower than someone who can move from, maybe bonds to stocks in the snap of a finger.
Well, thank you, Eric, for, fielding those questions, and, maybe it was cathartic to get it out, because I know you're dealing with it, and we all do in the industry, and great respect for your work. And next time I have you on, we'll be talking about how you were right, because now it's showing up in the real world.
If not, then I fully expect you to beat me up more than you did today.
You know what?
You'll have to hold my feet to the fire.
Let me tell you something. When I was a kid in grammar school, you'd go out on the playground, you'd have a fight with somebody, and they'd become your best friend.
Yeah.
Right?
But believe me, Dale, I've had you're very nice to me. I've had some less nice interactions. But no, in truth, all of my clients are always very respectful. This has been a difficult time for everybody in the markets. So I'm just trying to explain what I do. And I think it's also important to try and manage expectations around the fact that a business cycle process is not for everyone. If you're not willing to take a multi-year view, you can follow it as someone of interest, but using it for your trading strategy. If you're trying to trade the jobless claims number, I don't think you'll have a lot of success with that.
Well, thank you, Eric, and appreciate you updating us. And I think that you're going to be right. And maybe we needed sentiment to come all the way to there is a no landing. So I think it's going to take Captain Sully to land this plane. So anyway, Eric, thank you very much for your time today.
Thanks, Dale. I appreciate it.
And all your great edification of our community every time you're here.
Thank you.
All right, buddy. So Eric, check him out at EPB Research. And that's also his Twitter handle. And now you know how to use his information, not for scalping. So you could join the team in 7 minutes on the Morning Edge, everyone. And we'll see you tomorrow to wrap up the week. Don't just count your pips or indicators, count your blessings. Adios, everyone.